Silver is exploding, up nearly 130% over the past 12 months, and I keep seeing the same question everywhere. Is it too late to profit from silver's price action? In my previous video, I explained why I don't think this is just a short-term spike and why silver's breakout could actually last years. Today, I'm going to take that story one step further. Because once silver moves, it naturally pulls gold and even platinum into the conversation. Today in this video, I'm going to walk you through how gold, silver and platinum actually behave and how I have built exposure using a mix of physical metals, ETFs and mining stocks so that you as smart investors can potentially profit from these precious metals price action. So please watch till the end. Welcome back to Wages to Wealth. I'm Hitender and by day I work in credit risk at a major retail bank. My job is to ensure that the bank has enough money set aside if things take a turn for the worse. So for me, it's all about managing risk in a strategic and sustainable manner. Now this video isn't about predicting prices. It's about building a precious metal portfolio that makes sense across different market scenarios. So let's start with silver because that's where the whole conversation began. If you watched my previous video, you'll know that I don't think silver's move is random. Silver sits right in the middle of industrial demand, new technology and safe haven buying from investors. Solar panels, EVs, semiconductors, AI data centers, they all need silver. At the same time, supply is super tight. New mines take years and production just can't be ramped up overnight. Historically, silver tends to lag gold early, then suddenly catch up very fast. That's why silver moves are emotional. Big up days, sharp pullbacks, but when it runs, it really runs. That's why I think some of silver's strongest years could well be ahead of itself. Now, silver might be super exciting, but gold plays a very different role. Gold isn't about growth, it's about protection. Gold is a store of value, it's an inflation hedge and something central banks still hold in tremendous size. And when inflation rises, when currency weakens, when the confidence in the market drops, gold tends to hold its ground. From a risk perspective, gold behaves like insurance. That's why even when silver looks more exciting, gold still matters a lot in your portfolio. Then there is platinum, the metal hardly anyone talks about. Platinum is actually rarer than gold. It's heavily industrial and it's used in catalytic converters and hydrogen technology. What's interesting is that platinum used to trade above gold and today it trades at a massive discount compared to gold prices. And that happened because diesel demand collapsed, investor interest disappeared and industrial demand weakened. But supply is concentrated and any recovery in industrial or hydrogen demand could change the entire picture for platinum. Platinum isn't a momentum trade. It's a contrarian strategy. What do I mean by that? Contrarian investing is a strategy where investors deliberately go against prevailing market trends, buying assets that are out of favor because this leads to mispricing. And platinum, in my view, is currently mispriced. Here's where people often get it wrong. Gold, silver and platinum aren't competitors. They do very different jobs in a portfolio. Gold protects your wealth, silver grows your wealth and platinum adds potential upside. Gold smoothens the ride for you, silver adds a punch to your portfolio and platinum gives you exposure to mispricing. Together they actually work better than trying to pick just one of these precious metals. Now let me be very clear. This is not investment advice and please do your own due diligence and consult a professional if you need to. I'm simply sharing how I do it so that you can get an idea of how you can think about your own portfolio allocation. My personal precious metal allocation looks like this. 50% in silver, 35% in gold, 15% in platinum. Here's why. Silver at 50%. Silver is my biggest position because I truly believe that the breakout phase could last years and not months. Demand keeps rising, supply stays tight. Yes, it's volatile, but that volatility is where the upside comes from. Gold at 35%. Gold is my stabilizer. It protects my purchasing power and keeps the portfolio grounded when markets wobble. Even if silver outperforms, gold keeps things very much in balance. Now, platinum at 15%. Platinum is smaller on purpose. It's more cyclical, it's less liquid and more uncertain. But that's exactly why it's interesting as a contrarian position. How do I get exposure to these metals? I want to share my personal allocation so that you can get some ideas of how you can structure your portfolio allocation and potentially profit from the price action. Now, one thing I want to get very clear. I don't get exposure to precious metals in just one way. I deliberately spread it across physical metal, ETFs and mining stocks because each one behaves very differently depending on market conditions. Now, roughly speaking, my split looks like 10% in physical metal, 60% in ETFs, 30% in mining stocks. Let me break that down for you. First, physical metals. Yes, I do own physical gold and silver. I hold a mix of coins and bars. For example, silver bars, I personally stick with 999 fine silver rather than 4 nines. It's widely recognized, it's liquid and it's practical. Physical metals give me the peace of mind. There's no counterparty risk and it's something tangible that sits completely outside the financial system. That said, physical metal isn't very flexible and requires storage, which is why it's only a small part of my overall portfolio. Next, ETFs, which make up the bulk of my portfolio. About 60% of my precious metal allocation is via ETF because they are simple, they are liquid and easy to rebalance. For example, Invesco Physical Gold, ticker symbol SGLP, or Invesco Physical Silver, SLVP ticker symbol, or the Invesco Physical Platinum, ticker symbol SPPP. These are very good options. They are physically backed products that track the metal price closely and remove the storage of hassle. And finally, mining stocks. This is the most volatile part of the allocation, but also where I actually get leverage to rising metal prices. Around 30% of my exposure is in mining stocks. Some miners that I'm personally invested in is in Pan American Silver PAAS, First Majestic Silver AG, Coeur Mining CDE and Hecla Mining HL. Mining stocks can outperform the metal itself when prices rise, but they also come with company specific risk. So position sizing really matters here. For me, this mix works because physical metals provide the security, ETFs provide me with flexibility, and mining stocks provide the upside. It's all about balance, not going all in once on any single approach. So the key question, gold, silver or platinum? For me, it's all three. Gold for protection, silver for growth, platinum for the contrarian upside. And in this cycle, I'm more than comfortable giving silver a bit more weight. If you haven't watched the silver breakout video yet, I'll recommend starting there. It sets out the foundation for everything that we've spoken about today. If you found this video useful, please hit subscribe, turn on notifications and join the Wages to Wealth community. And please let me know in the comments, are you invested in gold, silver, platinum or a combination of the three? I'll be very interested to know this. I'm Hitender and let's turn those wages into wealth. Thank you so much for listening.